Good afternoon, and my name is Bob Zdenek. I'm the interim executive director of the San Joaquin Valley Housing Collaborative. Welcome to our afternoon sessions. We got a really good start with our conference with our two opening sessions, and we have really an excellent session prepared, on the low-income housing tax credit in a few minutes. But I want to first thank that the California Housing Partnership is leading, and I want to thank the California Housing Partnership for all their help with our conference and for being such a wonderful resource statewide and nationally. I mean, do such great work. And I had moved back to California 5 years ago, and I was doing work with quick story, with the Public Health Institute. And Kevin Barnett, who's great, he had 2 days to put together this homeless analysis for the state, for this blue chip panel consisting of like the head of Kaiser, et cetera. It was a statewide panel. And he said, Bob, we got to do it in 2 days. And I said, well, I don't know anything about homelessness, research, but I do know how to get to it. And so we used a lot of CHP's materials. We didn't plagiarize, but we wrote it and they really understood it. So I mean, it's just another example, not just of your knowledge and your ability to really impart housing and the importance of low-income housing statewide. So we're delighted to have you for this session, Fun in Low-Income. This is a really interesting title, Fun in Low-Income Housing Tax Credit Fundamentals. Now, the low-income housing tax credit is the most important rental housing program we have in the country, tool, I should say. But I've rarely seen it described as F, capital U, capital N. I usually think it's only fun if you're an accountant or a lawyer. But for the rest of us, it's pretty laborious. So I've really piqued my curiosity. So I want to learn how it's fun by the end of this session and learn some new strategies. And again, without further ado, I'm going to turn it over to Claire Parisa, who's going to help moderate and lead the discussions. Claire, welcome and thank you for doing the session.
Thank you so much, Bob. We're so happy to be here to talk a little bit more about, what I always consider to be sort of the beating heart of affordable housing finance, which is the low-income housing tax credit program. If you can understand low-income housing tax credit program, you can kind of conquer the rest of the affordable housing finance world. So we're just so happy to be here. I am going to go into my introduction in just a second, but I just want to let everybody know that if you're in the Whova app, at the bottom of the page, you can download something called presentation. It's a handout. It's just a PDF version of all the slides that we have that we'll be going over today. It's a really great way for you to be able to take notes on the presentation today. And there's some additional materials in the appendix that we will not be covering today, but that can help provide sort of additional reference material after we end the presentation. So please do take a moment to download that. And if you have a printer nearby, you can print it and use it to take notes when we get to the kind of more juicy sections. So I will now share my screen. Here we go. All right, Adrian or Saritza, can I get a thumbs up that you can see it okay? Okay, perfect, thank you. All right, so today we're talking about the low-income housing tax credit program. As Bob mentioned, the three trainers on the line today from the California Housing Partnership are myself, Claire Parisa, and I'm joined by two of my colleagues. So Adrian, who's a housing finance consultant, and Saritza, who's our director of training. You'll see Adrian and me giving the presentation today, and Saritza is actually going to be working to answer your questions as they come along during the presentation. And we'll talk in a second about sort of how to submit your questions. We're going to use the Whova tool. We'll see how that works. And then hopefully we'll have some time at the end to go through additional questions. In the meantime, we'd love to know who's here on this call. So if you feel so inclined, please go ahead and put your name and organization in the chat box. And we'll kind of get a sense of who's here with us today. Bob gave us a very flattering introduction about the California Housing Partnership, but here are just a couple of slides on sort of what we do as an organization and our reach. So we create and preserve affordable and sustainable homes for Californians with low incomes by providing expert financial and policy solutions to nonprofit and public partners. You can find us online. You can find us on Twitter We're hiring right now. If you like what you hear today, you can come join our team perhaps. And we're really proud of our accomplishments. You know, we've helped contribute to the creation or preservation of over 75,000 homes throughout the state of California. In our trainings, we've trained over 30,000 people, which is really one of our sort of very proud accomplishments. We're so happy to be able to provide these trainings and sort of spread the learnings on affordable housing finance and policy. And we've helped to leverage $25 billion in public and private financing for affordable housing. Okay. We do this through a number of different tools, including financial consulting, training, policy, and research. We also have a green team that works on sustainable housing in affordable housing. And we have a really great data tool set, chpc.net/data tools, where you can sort of explore our housing needs dashboard and also look at a map of all the affordable housing developments in the state of California. So today, these are all the topics we're going to cover in the low-income housing tax credit. There is so much more to explore than what we will cover today. We're really trying to give you sort of a broad overview that you can use that as a foundation to sort of build on as you kind of continue your adventure and learnings in affordable housing finance. So in the chat, if you have a moment, please go ahead and pop in of these topics. Sort of what are you most excited to learn about today? So we're going to go over tax credit program basics, sort of what the tax credit, how it fundamentally works, what is a tax credit. We're going to talk about the federal requirements for participating in the program. We're going to talk about how to calculate the credit, right? I have a development budget. How do I get from my development budget to the low-income housing tax credit? How does that work? What are the steps in between? We're going to talk about the different types of credits, right? So we've heard about the federal low-income housing tax credit. There are also state low-income housing tax credits. So we'll dive a little bit into that. We'll then talk about TCAC requirements and underwriting for how to participate on the state level. And then we'll talk a little bit about how do I obtain an application? I want to build affordable housing, or I want to rehab affordable housing. How do I go from sort of that concept to winning an award? And we'll talk a little bit about this. Fabulous. Okay. It looks like we've got a couple popped in the chat. The relationships of tax credit to bond financing and how to get more bond financing. Okay, that's a really good question. We're definitely going to talk. We're going to touch on bonds, but we're not going to go into depth on bonds. We actually have a separate training that we do at the partnership sort of just on bonds. Maybe we can find a way to share that information later on in the presentation. Okay. So just a couple logistics. Again, please download that PDF of the presentation when you can. It's on the Hoover portal. You'll want it to reference later. If you have questions during the presentation, there's actually a Q&A function in Hoover. So Saritza is standing by to answer all of your questions there. If you have sort of a really juicy question, time permitting at the end, we will handle those. And then keeping the fun and LIHTC fundamentals, we're going to have a few poll questions that will come up throughout the presentation. You may have seen them when you joined. You don't need to answer those now. All of those poll questions, the answers we're going to go through in the presentation. And that's sort of how in this digital platform, we're trying to make it a little bit fun. So hopefully you'll find some engagement there. Okay, fabulous. So let's dive right into the basics. So this part of the presentation, we're going to talk about how the low-income housing tax credit program came about. What is it? How is it sort of regulated and how to managed? And so the short story of the low-income housing tax credit was established through the Tax Reform Act of 1986 as a way to incentivize the production of affordable housing, right? And the IRS apportions 9% low-income housing tax credits to state allocating agencies. So while this is a federal tax credit, state agencies are responsible for determining how the tax credits are sort of allocated to different affordable housing developments across the state. We're very lucky because there have been a number of bills both passed and sort of on the table now to increase the amount of 9% low-income housing tax credits through legislation. And so in 2021, we received $2.81 per capita in 9% tax credits, which ended up being around $110 million, as you can see at the bottom there. Okay. So as I mentioned, these are federal credits, but they are sort of allocated and administered at the state level. And each state has to adopt a qualified action plan, which in the state of California is actually known as the TCAC regulation. So I went to grad school in Boston, and I remember coming to California and saying, where's our qualified allocation plan? People are talking about these regulations. What are those? Where's the qualified allocation plan? Well, it took me at least a month to figure out, oh, wait, these are the same thing. So in California, our qualified allocation plan is the same as the TCAC regulations. And TCAC is the Tax Credit Allocation Committee, and it's California's allocating agency. So TCAC is the one that oversees how credits are awarded to developments across the state. In addition to awarding funds, the credits, TCAC also monitors projects for 55-year compliance period. Okay, and one thing that's a little bit of an odd concept that some people have a hard time grasping is that credits, tax credits are awarded to a developer to build or rehab a specific building or buildings. Tax credits offset taxes, right? You may have heard of other types of tax credits, the earned income tax credit, the child tax credit, solar tax credits for solar panels on your roof. This is the same kind of concept, but they are tax credits that are delivered to affordable housing developers for building affordable housing. Now, what's a little bit odd about them is that instead of using those tax credits, instead of the developer typically using those tax credits themselves, what they do is they take those tax credits and they sort of sell them to an investor. And then with the profit that they get from selling the tax credits, they use that as a development funding source so that they can help build the building. It's a very strange concept, I admit, but it's one that really garners support from sort of both sides of the aisle, and is sort of a very kind of well-loved public-private partnership in the US. And so the tax credits are delivered an equal amount every year for 10 years. And the investor who's buying these tax credits will receive these tax credits in chunks every single year to offset their tax liability, how much tax they owe. In addition, of course, to tax credits, there's funding from public agencies, local and statewide. There are bank loans that are given, like a mortgage, like, you or I might have a mortgage. And then sometimes additional financing provided from other soft sources. And so altogether with the tax credits, these sort of constitute the sources of funds that you need to build an affordable housing development. Okay, great. That's sort of one of the core pieces, right? So as we talked a little bit about, the low-income housing tax credit provides an incentive, which is a tax incentive, which is an offset, right? So the way that tax credits work is, let's say a corporation owes $100 in taxes to the IRS. They can buy tax credits which offset dollar for dollar that tax liability. So if a corporation has $100 in tax liability, how much they owe, they can offset that. Let's say they have a $20 tax credit. Instead of paying $100 in tax credits in taxes, they'd pay $80. So 100 in tax liability minus the $20 credit gets them $80 in taxes still. And in the state of California, and in most states, there are two types of tax credits, which we'll talk about. Tax credits are allocated in California, those 9% credits, which are more valuable, are allocated in a competitive process, which is why it's so important for us to kind of review the obtaining and allocation at the end of this presentation, so we can talk a little bit about how you get these valuable tax credits. Okay, and then the amount of tax credits that any particular development can receive vary by the project. And we'll talk specifically about how to calculate that later in the presentation. The amount that each development gets sort of depends on a number of factors. It depends on the construction cost, right? The amount that you pay the general contractor to actually build the building, and construction related costs like architecture, engineering, things like that. All these costs we call them eligible basis. And that's sort of the basis upon which we calculate the tax credits. Also important are the percent of eligible units. What percent of the units are affordable in a development? If you have 50% market rate, 50% affordable, well, only the costs associated with those affordable units are going to be included in the calculation of the tax credit. And then when, for the more valuable 9% program, like LIHTC equity investments can provide up to 70% of the total development cost, which is really fabulous. With the 4% program, it's lower. So affordable housing developments are owned by limited partnerships. The limited partnerships are made up of two parties. The first is the investor, the limited partner, and then the second is the general partner. Usually some entity owned or controlled by the developer. So limited partner, general partner, and the limited partner typically owns 99.99% of the project, and the general partner owns just a tiny little bit. We'll, if we have time, we'll talk a little bit about that later. The investors usually participates in the development for 15 years, which is sort of the compliance period, how long the federal, in order to qualify for those credits, you have to be in compliance, and you have to rent those units at those affordable levels, but the credits are only delivered for 10 years. Keep that in mind. 10-year credit delivery, 15-year compliance. I'm not saying it's going to be a poll question, but it might be. Okay, I might be the only one having fun during this presentation. Okay, so there are two types of tax credits. I just mentioned a little bit earlier. There's the 9% tax credit, super valuable, but limited, right? So there's only $110 million of 9% credits available in the state of California this year. So it becomes really competitive. This is a valuable resource that's competitive. The 4% tax credit works in the same way. It's just a lower, a smaller amount of tax credits that you get for each development. Technically, the 4% credits are by right. They're non-competitive. However, this is the weird part, and this is what I think a couple of people may have been asking in the chat and Q&A about. The 4% tax credits themselves are not competitive, but they have to be paired with this thing called the tax exempt bond, which folks may have heard about. The tax exempt bond program is competitive. So 4% credits by themselves are not competitive, but sort of de facto they are because they're paired with the bond program. The bond program is competitive. CIDLAC, the California Debt Limit Allocation Committee, is the entity that oversees the bond program. So TCAC, tax credits, CIDLAC, bonds. Okay. So that's sort of the core piece of our of the low-income housing tax credit program. We're going to dive into sort of more specifics and on that, but if you can keep those pieces in mind, if that's what you pick up from the presentation today, sort of those are the core elements of the low-income housing tax credit. Next, we're going to dive into what is a tax credit. So we talked a little bit about this earlier. So a tax credit is a dollar for dollar reduction in taxes owed, right? So examples include the low-income housing tax credit, what we're here to talk about today. There's also one called the new markets tax credit. The business energy investment tax credit, also usually more commonly known as the solar tax credit. There's the earned income tax credit, child care tax credit, and higher education tax credit, right? So these are just some examples. Tax credits are one of the tools that the government can use to incentivize certain behavior, right? So these, in the government's eyes, these are things that they want to incentivize. And they incentivize it by kind of tipping the economics for things that are otherwise potentially don't make sense necessarily for an individual or organization to do from an economic point of view, right? So for example, it may not make sense completely, it might not pencil to put solar on your roof, but if there's a tax credit associated with it, the government is able to tip the economics. And so in the cost benefit analysis, you decide to put solar tax credits. The same with the low-income housing tax credit. This is a way that the government incentivizes developers to build affordable housing. Okay, so this is different from a tax deduction, right? So whereas a tax credit is a dollar for dollar offset of your tax liability, how much actual tax that you owe to the government, a tax deduction is a little bit different because this is a reduction of taxable income, right? So making the analogy again, the connections to us as individual taxpayers, a tax deduction you'll recognize, for example, as a charitable donation that you might make to a 501c3 organization. So let's say you have $50,000 of income. If you made a $2,000 donation to a nonprofit, you would be taxed on $48,000. So the tax deduction reduces your taxable income from 50 grand to 48,000. So you're only taxed on the $48,000 portion, right? So it's not the same and is not as valuable as a tax credit. And here's an example of, we don't have time to go into this in depth, but I really do encourage you to look at this after the presentation. But this is sort of an example with little smiley faces of how the difference between a tax deduction and a tax credit. So again, a tax deduction in all three of these examples, there's $1 million in gross income. Well, $200,000 tax deduction means you're going to be taxed on 800 grand of income, leading to $168,000 in tax liability. A $200,000 tax credit, on the other hand, comes out of the actual tax liability. And so you can see that's what's happening in this third column here. So your adjusted tax liability in that case would be only 10 grand. So this is sort of the math behind why a tax credit is more valuable than a tax deduction. Okay. At this point, I'm going to go ahead and pass it off to Adrian, who's going to talk a little bit about federal eligibility and affordability. Adrian?
Awesome. Thanks so much, Claire, for laying the groundwork. All right, so we are going to discuss federal eligibility and affordability. So a colleague of ours likes to explain the different requirements of how to use the tax credit program as a layer cake. So this layer, this base layer, is detailed in section 42 of the IRS tax code, which again makes up the base layer in a layer cake of requirements. Later on, we'll be talking about the next layer, which are the state requirements laid out by TCAC. But first, we'll discuss this base layer. To be an eligible project, the project must be non-transient rental housing. So non-transient, so it cannot be short-term rentals with the intended use of less than 6 months. Another requirement is that the resident's income must be less than or equal to 60% of the area median income. And the project must be new construction of substantial rehab. We'll talk more about how that's defined later on. And the acquisition of a building and the rehab of that building. All right, next slide. Okay, so what projects are not eligible to access tax credits? And again, this is still in that base layer of the federal tax code. So owner occupied buildings are not eligible. Any housing provided by one's employer, so this could be, firefighter or military, sometimes housing is provided, that is not eligible. Nursing homes, retirement homes, life care facilities, hospitals, dormitories, and mobile home parks are ineligible projects. Okay, so what are the affordability requirements set in the federal guidelines? So for your project, you must select one of these options. So 20% of units must be at 50% AMI, or 40% of units at 60% AMI. And then that last option is 40% of units at an average of 60% AMI. So this allows for income averaging, though the average must maintain that 60% AMI level. So we always recommend selecting the 40% at 60% AMI option. And the reason for that is that when you're using the 4% bond program, if you select 20% at 50% AMI, that actually limits that all units must be at that 50% AMI level or below. And so we encourage the 40% of units at 60% AMI just to preserve some flexibility. All right. Okay, so if you have not done this question yet, I encourage you to answer poll question number 1. And the question is, which minimum set aside is recommended for 4% projects? And we'll give you a couple seconds to answer that. And then if I could have the staff just send me the response, how people did on that, that would be awesome. All right, let's see those results. I'm waiting for them to come in. 12 out of 18, a nice job. Okay, so now we're going to talk about the term of affordability. So how long, what are the requirements for the term of how long projects are required to maintain their affordability? So Claire did talk about this a little bit. So at the federal level, in that base layer of the cake, there's the 15-year initial compliance period. So while the tax credits are delivered over just the first 10 years, the investor stays in the deal for 15 years. However, there is a required 30-year extended compliance period required at the federal level. However, the state of California requires a 55-year extended compliance period, which guarantees that affordability will be maintained for those 55 years. Okay, so gross rents. So where do these numbers come from? So TCAC publishes gross rent levels, and this varies by county and by bedroom size. So the rents are determined by the calculation is 30% of the published AMI. So rents cannot exceed that level, and that is what is published. So this is not to be confused with 30% of the household income, but rather 30% of the published income level based on the geographic area and the unit type. And so again, TCAC publishes these gross rents, but residents also have to pay for utility allowances. So utility allowance estimates are published by the Housing Authority. And this is also based on the size of the unit and the cost of the utilities in that jurisdiction. So those utility allowances are then deducted from the TCAC gross rents, and that gets you the net rents that are then charged to the residents. There's also something called a California Utility Allowance Calculator. So this is a different type of utility allowance in which you often hire an energy consultant to run a calculator that takes into consideration the specific systems of your building. including, windows, HVAC systems, and other considerations, and develops a more specific utility allowance. And this can also be used in place of that utility allowance given by the housing authority. All right, with that, I'm going to pass it back to Claire, which this is my favorite part, to discuss how to calculate the credit.
Thank you, Adrienne. Okay. It's funny that you love this. I mean, that's why you're a financial consultant. It's not everyone's favorite part. And I have to admit, the very first time somebody talked to me about how to calculate the credit, it totally went over my head. I was so confused. I really didn't understand why it was calculated that way. But once you get more familiar with the affordable housing, finance world and the low-income housing tax credit, the calculation will make sense to you, both from sort of just a purely mathematical, okay, I know what step is next kind of point of view, but then also you'll understand as you go along sort of the policy reasons for each of the steps in the calculation, what the federal government is hoping to incentivize, and how it's sort of made fair, the amount of credit that you're able to generate on your development. So we'll go ahead and dive in. Again, I really recommend that you take that PDF that's available to you at the bottom of this presentation in Whova, so that you can follow along as we go, and then also sort of reference this material, because it's a multi-step calculation. It's nothing, we're not going to be doing calculus here. It's really just, multiplication, addition, but there are a number of steps. Okay, so let's jump in. So earlier in the presentation, we talked a little bit about this concept of eligible basis, right? And eligible basis is sort of the very first step that we, calculating eligible basis is the very first step that we do in order to calculate the low-income housing tax credit. And what we do is we take a full accounting of all of the items in our development budget, all the line items, the costs that it takes to build the affordable housing development. So paying the general contractor, paying the architect, developer fee, buying the land, paying the legal fees, the financing fees, construction loan interest, all these things, right? We have a whole accounting of that. That's the development budget. From that, there are certain costs that will be used to go into the calculation of the tax credit. And these costs are called eligible basis. And they include the costs of acquiring, rehabilitating, and constructing a building. Costs that are included before the building is complete, that is termed placed in service, that some of you may have heard of, right? These are costs incurred before that date, before the building is complete construction and ready for residents to move in. And it doesn't include costs that are incurred after that are associated sort of with the permanent operations of the building, not the construction of the building. It is similar, if you've heard of depreciable basis. Generally, eligible basis and depreciable basis sort of line up. They're the same thing, generally. Eligible basis does not include land costs, permanent financing costs, any reserves like your operating reserve, any expenses related to syndication, where syndication is the sale, the sort of the process of selling your tax credits, right? So any costs associated with that, any marketing costs to actually move residents into the building and advertise the building, all of those costs are not included in eligible basis. When you're a developer, you will hire an accountant who will make the final call at the end of the day when the construction is complete on which line items are in or out of basis. Some line items are enter sort of a little bit of a gray area. As financial consultants, we use sort of the most up-to-date information from accountants and tax attorneys to determine what's in and out of eligible basis and make an estimate of that. So here is an example. what's included and excluded from eligible basis. So let's say we've got this hypothetical development where we have $6.4 million in total development costs. Only a portion of that's going to be included in eligible basis. So while our total development costs total 6.4 million, in eligible basis, we've only got $5 million. Okay, that's the first step, eligible basis. The next step, we're going to take that eligible basis, the eligible basis figure, and we're going to apply a high cost adjustment. And then we're going to follow all the rest of the steps we're going to go through. Now, the high cost area adjustment, you may have heard people talking about the importance of developing within what's called a DDA or QCT. So those are small area difficult to develop areas, SADDAs, or qualified census tracts, QCTs. Now, what happens is if you happen to develop your property or rehab your property in one of these areas, you automatically take that eligible basis and you multiply it times 130%. So it can make a really big difference in the feasibility of your project. If you're in a QCT or a DDA, HUD publishes a map every year about the specific QCT and DDA areas, and they change annually. Here's a map of DDA and QCT areas. Of course, this is inappropriately for this audience, just the Bay Area, LA, and San Diego, but the maps look really very similar, you know, in the Central Valley and the rest of the state, where areas that are colored in here are either in a DDA or QCT. And you can see that it's fairly common to be in one of these areas, luckily. The real problem becomes sometimes when projects change. You know, these maps change every year, and they might be in one in pre-development early on and fall out of one later. Luckily, the state of California has a way of accounting for that. Okay, so let's say in this hypothetical calculations, hypothetical project that we're looking at, we are in a high cost area. So we take that $5 million in eligible basis, we multiply our high cost adjustment of 130%, and we get an adjusted eligible basis of $6.5 million, right? Okay. Next is the applicable fraction. Now, the applicable fraction applies to what percent of the units in a property that you are developing or rehabbing are going to be rented to low-income housing, low-income tenants. So as you can imagine, the government is not interested in providing an incentive to a developer to develop market rate housing, because generally market rate housing, there doesn't need to be an additional profit incentive because it's already profitable for a developer. So the federal government says, no, we're going to take the applicable fraction, the percent of the units that are affordable, and apply that to your adjusted eligible basis. And they take the lesser of either the unit fraction. So if we have a 100 unit building and 80 of the units are affordable, well, then we would use 80 over 100, right? 4/5 would be our applicable fraction, or the floor space fraction. So if there's fewer, if the market rate units are larger, for example, than the affordable units, well, you're going to get only the floor space fraction because it's going to be a lower fraction. So it's the lesser of the unit or floor space. So there's an example here at the bottom, which you can revisit after the presentation. And in this example, we're saying that it's 60% is the lower of the two, and that's our applicable fraction. Okay. So we sort of did that. Okay. In this case, in this example, the applicable fraction we're going to say is 100%. So in this hypothetical, 100% of the units are affordable. And so we get to choose, we get to include all of that adjusted eligible basis in our next step. So we take the 6.5 million, we multiply it times 100%, right? And we get 6.5 million qualified basis. Next, we're going to go to the tax credit rate. And this is where that delta between the 4% and the 9% credit comes in, right? So we're going to take this $6.5 million and we're going to multiply it times either 4% or 9%. And this is sort of the core of where these two programs are different in terms of the amount of credits that they deliver. So if you can imagine a 4% credit is 4% times 6.5 million, it's going to give us much smaller number than 9% times 6.5 million, right? And so the 9% program delivers more tax credits, is more valuable than the 4% program. Okay, so we'll talk about that. Again, this will create this multiplying the qualified basis times 9% or 4%, it's going to get you your annual tax credit. So in this example, we're going to pretend this is a 9% deal. And we take that $6.5 million, we multiply it times 9%, and we get an annual tax credit of $585,000. What you may remember from earlier in the presentation is that these tax credits are delivered over 10 years. So the next thing we're going to do in this calculation is take this $585,000, which is the amount of tax credits that will be delivered every year. We're going to multiply it times 10 years. Okay, this is maybe the easiest step. Oh, 1 second, I gotta, okay, never mind. So we take the 585,000 and we multiply it by 10, should get us $5,850,000 in total tax credits, right? So this is what the federal government, the IRS, is going to allow in tax credits. Now, as you may remember, the next step in this whole process is taking those tax credits and selling them to an investor. And so that's going to tell us how much money we actually have to put into the development. And the investor's not going to necessarily give us $1 of investment, right, for every single dollar of tax credit that we generate. They may give us less. In previous years, they used to give us more than $1 for many developments. When I was a project manager a few years ago, I got $1.20 for every dollar of tax credit that was generated in this deal in San Francisco I worked on. Now it's much less than that, right? So in this case, we're going to say that for every dollar tax credit that we have been awarded that we want to sell to this investor, they're going to pay us 95 cents. And this amount is a negotiated amount based on sort of the characteristics of your deal, based on your relationship with potential investors, and based on some other sort of tax attributes of your deal. So that price is sort of set by the market and the characteristics of your deal. So we've got the 10 years of tax credits. They're going to pay us 95 cents for every dollar of tax credit we generate. So in this case, we had $5,850,000 in total tax credits delivered over those 10 years. The investor will pay us 95 cents for every single dollar of those tax credits that we generate. And the investor's equity is going to be $5,557,500. That's how much money they're going to put into the development that we can use towards building the building. And I'm just seeing here on the chat internally that we've only gotten a few questions from people. So please feel encouraged to put your questions in the Q&A box. Sarita is standing by. And if you have a juicy one, no, sorry, my dog is barking. If you have a juicy question, feel free to pop that in there and we'll get to it at the end. We really encourage you to ask questions. This is confusing and kind of weird and sort of unnatural almost concept, right? These low-income housing tax credits are a bit of a bizarre concept. So please feel encouraged to ask questions in the Q&A. Okay. So there's that last calculation. So again, the factors that we've touched on a couple of these, the factors that affect the amount of credits. So the amount of eligible basis, right? Whether or not the project is in a DBA or QCT, whether they're going to get that 130% basis boost on the eligible basis, the percent of units that are tax credit eligible and uses affordable housing, the actual tax credit rate, whether it's 4% or 9%. And then this last bullet really relates to the fact, this is a little bit of an oddity in the calculation, but you subtract your energy, right, your solar or historic credits from this calculation. And we don't need to dive too much into that, but essentially this is keeping you from double dipping on tax credits. Okay, now poll number 2. If you can please check out the poll section of the HUVA portal. There should be 2 poll questions there. So credits are normally delivered over blank years, and the initial compliance period is blank years. Okay, that's the first question. So try that one out. The next one is a true false. Eligible basis and qualified basis are the same thing. And I'll take a look at the polls here and see if they're coming through. Okay. Oops. Okay, so the first question I'm seeing, we've got about 16 people answering. Yes, great. The majority of you got this one correct so far. Credits are normally delivered over 10 years, and the initial compliance period is 15 years. So nice work on that one. Okay, and then the next question, I will open this. This is the true false. Eligible basis and qualified basis are the same thing. We've got 10 out of 14 people saying false. That's the correct answer. I'm going to go back so we can just quickly look at qualified basis versus eligible basis. For those of you who might be a little confused about this one, right? So eligible basis, remember here, is a list of costs that are associated with the construction of the building. Qualified basis is eligible basis times the high cost adjustment times the applicable fraction, right? So qualified basis is really related to how is sort of adjusted based on how many units are rented to affordable tenants. And so that's what the qualified basis is. So indeed, they are not the same thing. All right. With that, I think I will hand it off to Adrian, who will go through the types of credits.
Thanks, Claire. All right, so we are going to dive into a little bit deeper of the difference between the 9% and 4% tax credit programs. So we'll start by talking a little bit about the 9% program. Next slide. Thank you. Okay, so as Claire mentioned, the 9% program is highly competitive. And so Claire talked a little bit about how that is allocated to our state allocating agency, TCAC. And it is based on the population of our state. So it's the credits are based on $2.81 per person in the state of California. And that is the number of credits that are allocated to the state, which are then competed for these different projects. So they are so valuable because there is a limited number of 9% credits, and they generate a really large amount of tax credit equity. So there is actually a per project cap. Because they're limited, there's a 2.5 million annual per project cap. And remember, in the calculation that Claire went through, that is an annual credit, and that would be multiplied by 10 because those credits would come in at a maximum of 2.5 million per year for 10 years. And perhaps you've heard about the 9% disaster credit program. So that program is a little bit different in that it does not have this $2.5 million cap. And, you know, it's subject to change, but most recently has been at a $5 million per project cap. So it's quite a bit higher. Okay, so when it's allocated to the state, it is then competed for, and you compete in different buckets. So there are 12 geographic regions in California. So you can compete in your region. There are also 4 set-asides with specific requirements, and we're going to go into that in quite a bit more depth. And those 4 set-asides include nonprofit, rural, at-risk, and special needs. So in addition to those 12 regions and the 4 set-asides, your 9% project also must be a housing type. So those housing types are large family, special needs, at-risk, and seniors. So we will go through this again, but as an overview, you have the regions, the housing type, and then the set-asides. And this is in the 9% competitive program. All right, so the 4% program is quite different. So it is technically a non-competitive program. However, at the federal level, so that base layer of the layer cake, it is required that the tax-exempt bond program and the 4% program are actually attached. And the bonds, the tax-exempt bonds, are allocated through SIDLAC, and that is a very competitive process. It has not always been competitive, but right now it is. So in order to access 4% credits, you have to be successful in getting your tax-exempt bond allocation through SIDLAC. And if that SIDLAC competition was not competitive, then you just have to meet threshold requirements, and there is an unlimited amount of 4% credits, but that is not the environment we're in right now. So unlike the 9% program, there's no per project cap on 4% credits. So the 9% program had that 2.5 annual limit per project. That does not exist for the 4% program. However, again, as Claire mentioned, because it is 4% compared to the greater 9%, it does generate lower credits and less equity. Okay. So now we'll talk a little bit about project types. So this is for both 9% and 4% projects. So you can have a new construction project, which is often, a ground up project. And your eligible basis comes from the activities related to the construction and construction related costs of that building. There are also acquisition and rehabilitation projects. So you can get acquisition credits, and that is based on the cost of acquiring the building. However, the land is not included in that. In addition to acquisition basis, you would also have the rehab basis, which is made up of the costs associated with the rehabilitation of the building. So there are some minimum rehab tests. So in the base layer of that layer cake, the IRS federal minimum that you have to spend per unit is $7,100. However, on the next layer, so at the state level, you have the TCAC requirement of $40,000 per unit for rehab projects, or 20% of the eligible rehab basis. SIDLAC has a separate requirement, and that is $15,000 per unit. Okay, so now we'll talk a little bit about the credit rates for the different pieces of these different projects. So for new construction 4% projects, you have that 4% credit rate on the construction related costs, and you do not get any acquisition credits for a new construction project. Next up is the new construction 9% project with the 9% credit rate on the new construction eligible basis, with nothing on the acquisition basis. For an AC rehab project that is a 4%, you get 4% on the rehab eligible basis, and also 4% on the acquisition basis. So again, that is the building that you are acquiring. For an AC rehab that is a 9% project, you have 9% on the rehab eligible basis, but it actually is only 4% on the acquisition eligible basis. So it's a little bit different for that one. Okay, so just a review of some of the main differences between the 9% and 4% credit. So the 9% credit is competitive. Eligible basis is made up of the construction costs, which include hard costs, relocation, engineering, and soft costs related to the construction activity. Costs that are not in eligible basis, and Claire went over some of these, are reserves, any costs related to your mortgage, TCAT, and TCAC fees. For the 4% credit, the credits themselves are not competitive, but the bonds themselves are. So it's a little bit tricky. And then the construction costs, similar to the 9%, are what make up your eligible basis, and that's how you get your tax credits. Okay, so now we're going to go into TCAC requirements and underwriting and how to obtain an allocation. So we'll start with TCAC requirements and underwriting. So now we are up at the second layer of the base layer of the layer cake. So these are the state threshold requirements set by TCAC. So the first one you see here is that so when an application is submitted, a market study needs to show demand for the project, and the rents of the project need to be 10% or more below market, and that will show in the market study. The applicant needs to hold site control, so that could be in the form of a grant deed or a purchase and sale agreement. You also need local approvals and zoning. So the site needs to be zoned for the intended use. So the application must show financial feasibility. So when you submit, you include a financing plan, financing commitments, all showing that the project is feasible, but also that it is not overfunded. So there are also experience minimums for the developer and the management company. And then there are also minimum construction standards. These are spelled out in more detail in the regulations, but they include roofing requirements, doors and windows, as well as accessibility standards. Okay, so Claire mentioned that we have an appendix with more information. So we have a lot more information on these items in our appendix. So these are several TCAC underwriting requirements, which include limits for the construction contract, what the requirements are for the operating and replacement reserves, cash flow limits, trending and vacancy, the minimum operating expenses, which are determined by your location, and the developer fee limits. So please, we really encourage you to refer to that appendix, which is in the PDF for more details on that. Awesome. Okay, so now how do you get an allocation? So as we've talked about a couple times, there are the allocating agency for the state of California is TCAC, or the Tax Credit Allocation Committee. And that's for both 4% and 9% credits. And we have the website up on this slide. And then SIDLAC allocates the tax exempt bonds. And the website is also here. Okay, so ways to get credit. So the 4% credits, as we've talked about, are non-competitive. If you meet the threshold requirements and receive a bond allocation, you are guaranteed 4% credits. But the big hurdle here is getting that bond allocation. So on these 4% projects, SIDLAC and TCAC are really working together. And once you get that bond allocation, then you're in the door for your 4% credits. On 9% credits, you get the 9% credit on the construction basis. And if it's an AC rehab, it's the 4% on the acquisition basis. There's a limited amount of the credit, and it involves a pretty tough competition. So in California, we also have state credits, which are acquired through competitive allocations as well. So you get the 4% credit on both acquisition and construction related basis. But the state credit is only on construction basis unless you meet the at-risk definition, which we'll talk about in a little bit. And then you would also get it on the acquisition side. So if you're interested in state credits, an application is submitted in the same round as the 4% funding rounds. Okay, we've got our next poll question. So if you haven't done this yet, now is a good time to do them, and I encourage you to do so. So the first question is, tax exempt bonds can be used with both 4% and 9% credits. So this is a true false question. And then the second question is, both 4% and 9% tax credit applications are competitive. So I'll give everyone a couple seconds to complete both of those, and then I'll ask one of my team members to send me the responses. Okay, so it looks like on the first question, we had kind of a mix of answers. So tax exempt bonds are only used for 4% projects. 9% projects have taxable debt. So I know that can be quite confusing, but only the 4% program is paired with the tax exempt bond program. Okay, and then on the second question, which says both 4% and 9% tax credit applications are competitive. This is tricky because what 4% credits themselves are not competitive. It is just the bonds that are competitive. So 4% tax credit applications are non-competitive. They are only limited by the fact that the tax exempt bonds are competitive right now in California. So that is a really tough one. There's a nuance there. We'll just keep repeating that because I know it can be a tough concept, especially with such a changing landscape in California. So thanks to everyone who participated on those questions. Okay, so now we're going to talk about some threshold requirements for the 9% program. So we mentioned earlier in the presentation that it is required that all 9% projects must meet one of 4 housing types. So there are a list of requirements for those housing types, and I'll just go over a handful of them now. So for the large family housing types, the main requirement is that at least 25% of the 3-bedroom units, 25% of the units must be 3-bedroom or larger. And then an additional 25% must be 2 bedrooms or larger. For the special needs housing type, the average area median income cannot be more than 40% units. 40% of area median income. And the minimum number of units to serve that special needs population is at least 45% of units. However, if less than 75% of units are special needs, then the units that are non-special needs need to meet an additional housing type goal. So for example, those non-special needs units would need to be large family or another housing type if less than 75% are special needs. For the senior housing type, all units are restricted to seniors age 55 and older. So this used to be 62, but it's now been changed to 55. And then at risk means that the housing currently has federal subsidy and the project is at risk of converting to market rate. So it's at risk of converting to market rate housing. Okay, here's some additional 9% threshold requirements. So at the time of application, all deferred payment, financing, grants, and subsidies need to be committed. There are some project size limits. So if you are a rural project, the limit is 80 units. There's no limit for rehab projects. And if you would like to request a waiver to some of these, to a specific requirement, that must be done before the application. And as we talked about earlier, the rehab requirement is $40,000 in minimum rehab costs per unit, or 20% of adjusted basis. And it's whichever one of these is higher. Okay. So here's some additional requirements. So different housing types do have different requirements. So for amenities, there must be a washer and dryer for every 10 units. Large family projects do have play space requirements for children. Resident services, so if it's a special needs project, there are more specific resident service requirements. And then there are also square footage minimums, and this applies to all projects. Okay, and so this is what the point system looks like for 9% projects. So there's a total of 109 points, and you'll see a variety of categories here. So experience, housing needs, amenities, both site amenities and service amenities, lowest income. So this is how to structure your income targeting to get those full 52 points. Your readiness to proceed, and then some additional federal and state policies. So in almost all situations, it is required to get those full 109 points to compete. And then it moves on to the tiebreaker, which we will discuss in the next slide. Okay, so if you're a project in Los Angeles or San Francisco, and you have a formal letter of support from the agencies there. So in San Francisco, it's SF, Mayor's Office of Housing, or HCLA in Los Angeles. That formal letter of support will push you to the top in your region. So the first, then you have housing type. So say you have two projects with the same score, but one is a senior project and one is a large family housing type. And the large family housing type goal has been met already, then the senior project would be funded. However, if you have two projects with the same housing type and both housing type goals have been met or neither have been met, then you go to this this tiebreaker, which focuses on soft financing over total costs and incentivizes a lower credit request. So this very complicated formula, which we will not be asking you a quiz question on, is the formula for that tiebreaker. Okay, so this is a flow chart of how the 9% allocation system works. So you see at the top, it's all of the 9% credits that are available in a given round. And you have a portion going to the set-asides that we went over, as well as the geographic areas. And there are 12 geographic areas for TCAC. And the large red oval on the left that is around the set-asides. So that signifies if a project is not funded in those set-asides, it can then get a second bite of the apple and fall to the geographic areas to compete in those areas. So this is pretty complex, and we do have more information on how the allocation system works, as well as a map of the geographic areas in the appendix for more details. All right, so we can now take some time and see if there are any questions that have not been answered or any additional questions that have come up.
Great. Adrian, thank you so much. While we wait for questions, additional questions that folks are interested in learning about and asking in the Q&A function, I thought we might revisit this kind of our curveball question, right? About the competitive nature of the 4% and 9% credits and bonds. while we dive into that, if folks want to, please feel encouraged to put your questions into the Q&A box. We can get to them. We've got, about 15 minutes or so to answer questions, which is a sort of luxurious amount of time. We don't always have this much time to answer questions. And there are no questions that are silly or too simple. And in addition to answering questions you may have, we can always go back to visit any particular portion of the PowerPoint that you want to talk about. So please feel encouraged. So I thought, we just might touch on this idea about the competitive nature of these two routes, right? The 4% versus the 9% route. As Adrian and I have talked about during the presentation, really, it's true that the 9% credits, right? Because those credits are so much more valuable, and because there's a cap at the state level on how many credits the allocating agency TCAC can hand out, those credits are competitive, right? Adrian just went through with you the sort of the scoring system and the tiebreaker that is used to determine how those credits are allocated. And typically on a 9% deal, or in the 9% application pool, I should say, it almost always comes down to that third tiebreaker that Adrian went into, which I will just go back to here. Sorry, the second time. Well, right here it's listed as the second tiebreaker. We often call it the third tiebreaker because of this sort of initial tiebreaker being sometimes the first. So the 9% program, hands down, is always competitive. The 4% program, that route traditionally has not been competitive. Typically, it's always been over the counter. You apply to TCAC for your credits and SIDLAC for your bonds, and you were sort of given over the counter by right a credit allocation and a bond allocation. However, as Adrian mentioned, the bonds, just like the 9% credits, are limited at the state level. So there's a certain dollar figure that's awarded every single year to each state in bond authority. There's such an influx of affordable housing development and rehabilitation in the state nowadays, because we've had these statewide and local measures to provide a sort of local and state dollars to affordable housing, that sort of really increased and ramped up our ability to produce affordable housing, that we're sort of hitting the cap on the bonds. And so the bonds have become competitive. And by that fact, the route, right, using the 4% credit, sort of doing a 4% deal, using the bonds and 4% credits, has become competitive. But technically the 4% credits themselves are not competitive, it's the bonds that are competitive. And this is sort of a confusing topic and concept that a lot of people really struggle with. But just keep in mind, 9% always competitive. 4% credits not competitive, but bonds are. And so that's how that happens. Teresa, I see you popping on. Did you want to add to that?
Yeah, I mean, I'll just frame it the way I always think about it. You actually can't get 4% credits without tax-exempt bonds. You actually need the tax-exempt bonds to finance 50% of your construction to open the door to your eligibility for 4% tax credits. And the non-competitive competitive status of the credit programs are federal, they're federal statute. So TCAC can't make a decision that suddenly they want to make the 4% program competitive. It's non-competitive by statute federally. And again, I've always thought of it as the taxes and bonds open your opportunity and door to the 4% non-competitive credits.
Thank you, Zaritza. So sort of related to this kind of concepts of how the bonds and the credits overlap, we did get a question from Margie in the chat about 9% credits. Can they also use tax-exempt bonds? And the answer is no. You cannot use the tax-exempt bonds with the 9% program. You can only use tax exempt bonds with a 4% program. In fact, if you were to somehow use tax exempt bonds on a 9% deal, your 9% credits turn into 4% credits automatically. So you do not want to touch bonds with a 10-foot pole when you've got 9% credits on the line. That's a great question. Are there other questions coming in? Let's see. Looks like we don't have any additional questions. Okay, well, I think in that case, I might spend 1 or 2 minutes on one part of the presentation that we cut out before, just so that you can see this one part, which goes over sort of the timeline of how to apply for the tax credit. So as you can see, I'm in the appendix section here that Adrian and I both mentioned that you'll want to reference. But I just wanted to share briefly with you all the 9% tax credit timeline and the 4% tax credit timeline. So how you go from application through all the different steps that are required to participate in this program. And so just be sure to take a very close look. In fact, if you have a 9% deal, I recommend printing this out, putting it on your wall, because these are all really important deadlines that are required in order to participate in the 9% program and then the 4% program. Everything in black text that you see on the screen here is sort of a federal requirement, right? Adrian talked about that layer cake where we've got the federal requirements and we've got the state requirements. And everything in green is a state requirement. And so, to participate in the 9% program, first you apply, and then if you're successful, you receive a preliminary reservation of tax credits from TCAC. And then you have to submit a carryover application and meet a test called the 10% test by October 31st of the year you received reservation. Don't be spooked on Halloween by forgetting to submit that one. Then within 180 days of getting your reservation of tax credits, you have to be ready to start construction. That's really important. And then by the end of the second year following your reservation, you have to be done with construction or done with rehab. And then you must submit your tax forms to TCAC within 1 year of the place in service date, of the date of finishing construction. 4% program has fewer requirements, right? If you think about it, people are willing and able to jump through more hoops on the 9% program because it's more competitive. So on the 4% timeline, you apply, you get a preliminary reservation. Similar to TCAC, you have to close construction financing within 6 months. This is actually a requirement of the bond program. And then the next, then you don't have a deadline on when you have to finish construction, but you do have to submit your 8609 request, which is sort of your final determination of tax credits within 1 year of the construction, of the completion of construction on your final building. Okay, and I think, is that it on the Q&A? We might end up ending early if no one has any questions. Unless there's anything, Adrian and Zritza, you want to share. Okay. Last call for questions. All right, well, I think we are all done. I will stop sharing my screen. Thank you so much to the San Joaquin Valley Housing Collaborative for having us today. We're so happy as always to be able to participate and provide trainings like these. We are available after. If you have questions, you can email us at info@chpc.net. We can help answer questions. If you want to visit our website and see more of the training opportunities that we have, to learn more about the bonds or take a deeper dive on the tax credits, we have those trainings available. So thank you so much, Bob.
Actually, I had 2 questions.
Great.
That I put in the chat earlier. So I can't get access to HOVA.
Oh,
One was is environmental remediation an eligible activity within acquisition, or?
Yes, okay. We actually answered these ones in the chat, so I apologize. We can totally go through them live. Environmental remediation is not considered an eligible basis because it's part of the land costs. And we had that slide which talked about which costs are ineligible and land costs are ineligible.
I saw that, but I just didn't know how it sort of played out.
Yeah, I know. Yeah, I mean, one of the curveballs here is that sometimes site work, like landscaping, can be included in eligible basis. And so this is sort of one of those gray areas where sometimes it's included, sometimes it's not. It's really up to the accountant to make the determination.
And then the other one was more around how do you raise the money. And so my understanding is it's traditionally been corporations and businesses that, but what about all these high net wealth individuals in California who have huge tax liability? Are they sort of purchasing tax credits or interested or? Yeah,
so Zaritza answered this one as well. And I'll just read her answer because I couldn't phrase it any better myself. Zaritza says that is correct. The majority of tax credits are sold to corporations. Tax credits are not generally marketed to high net wealth individuals on a deal by deal basis, but can be part of a syndicated fund. Yeah. This is still a small portion of the investors in the market. And what Zaritza means by a syndicated fund is that sometimes an investor will invest in the tax credits on a development in order to use the tax credits themselves. And sometimes they'll be part, and I know you know this, Bob, but really explain it for the audience, will be part of, there can be sort of a go-between, right, who will buy the tax credits and then other people will use them. And that's sort of a syndicator buys the credits and then sort of, they have additional investors that are sort of part of a pool that's investing in those tax credits.
Seems a lot more complicated than I guess the traditional corporate or business. I was just trying to figure out how you raise money, and the various avenues. So okay, well, thank you. Again, my head's swimming. I learned a lot today. I think I have a much better sense of sort of the broad concepts, and then I just have to sort of go back occasionally look at. But I'm not doing. But so for our members and our developers, thank you so much, and for everybody who attended the session. This was a really great and informative session, and thank California Housing Partnership for your really critical work on behalf of low-income housing throughout the state. We're going to take a break till our last session today is at 3 p.m. on manufactured housing. So please take a break and join us at 3 p.m. And again, thanks to our colleagues at California Housing Partnership.
Thank you so much.
Thank you.
Bye.
Bye.